Welcome back, everyone. Ready for another deep dive.
Absolutely. Always ready to jump into some fascinating ideas.
So we're going to tackle long-term investing today.
Yeah, one of those essential topics everyone's always thinking about.
We've got excerpts from this book, and it kind of throws a wrench into the whole buy and hold strategy.
Oh, really? Digging on the classic advice, huh?
Yeah, I mean, we always hear ride the market waves.
Yeah, it'll go up eventually, that whole thing.
Right. But this book asks, what if that's not always the case?
Interesting.
I know, right?
So what's the book's angle? What's it using to make that point?
Well, they use this really compelling case study at the Japanese stock market.
Oh, wow.
Yeah, the Nikkei 225 index, to be exact.
Nikkei, okay, so that's like their Dow Jones, right?
Right. Tracks the performance of Japan's top companies.
Okay, I'm following.
So imagine it's December 1989.
All right.
The Nikkei's at its peak.
Everyone's feeling good, market's booming,
Exactly. You decide to invest $1,000.
thinking you're set for the future.
Feeling pretty smart, right?
Yeah.
Now, fast forward, not a few years, but 2 whole decades.
2 decades, wow.
At the end of 2009, that $1,000, it shrunk to a measly $271.
Ouch.
Yeah, ouch is right.
That's a pretty brutal illustration of how buy and hold can backfire.
Totally. It shows that even though it works a lot of times, it can really hurt you if the market just doesn't recover the way you expect.
Makes sense. And the Nikkei, didn't it peak in December of '89?
Right?
And even after all that time, it was still way below its high.
Oh, yeah, like 76% below.
Wow.
I know. It's kind of mind-blowing.
Seriously, I mean, I know markets go down,
Yeah.
but to hold on to something for 20 years and lose that much
Right.
makes you really rethink the whole buy and hold thing.
I'm starting to question everything I thought I knew about investing.
Well, good thing we're diving into this. But wait, so it wasn't just a straight drop for those 20 years?
Ah, that's where it gets even more interesting.
Okay.
There were actually years when the Nikkei went up.
Up. Within those 2 decades.
Yeah, and some years it even went up a decent amount.
So there were glimmers of hope
Right, but ultimately those gains, they got wiped out.
by the overall downward trend.
Exactly, so you might have felt some relief during those up years.
Yeah, thinking things were turning around.
Only to have it all disappear later.
So what does the book say to do instead? Just sit there and watch your money evaporate.
No, they actually propose a pretty radical alternative.
Lay it on me. I'm intrigued now.
Okay, so they introduce this thought experiment.
All right, I love a good thought experiment.
What if we completely removed all the negative years from the calculations?
Wait, what? Just pretend those down years never happened.
Yeah, like treat them as a 0% return, no gain, no loss.
Bold move, but I kind of like it.
And then to make things even more level, they say to cap any yearly gains at 14%.
Okay, so no crazy spikes, just steady capped growth.
Exactly. Sounds weird, right?
It does, but I'm curious to see where this is going.
Me too. So basically, instead of riding that roller coaster all the way down,
Yeah, all those drop.
we're acting like they never even happened.
Now, how does that play out with our Nikkei example?
Okay, remember how that $1,000 ended up as just $271 after 20 years?
Yeah, pretty dismal.
Well, if we apply this new approach, removing the negative years and capping the gains, that same investment would have grown to over $2,200.
Hold on, really? Just by tweaking the calculation like that?
Yep, that's the power of eliminating those losses and focusing on consistent, limited gains.
Wow, that's a huge difference.
I know, it makes you wonder if we can actually pull this off in the real world.
Yeah, how do we translate a thought experiment into an actual investment strategy?
Well, that brings us to the heart of what the book is really emphasizing, capital preservation.
Right, protecting what you've earned.
Making sure that market drops don't wipe out years of hard work.
Exactly, that's got to be the top priority.
But isn't some risk just part of investing? How do we balance that with this idea of consistent, limited gains?
That's the big question, and the book argues a lot of investors don't find that balance very well.
Makes sense.
They get so focused on chasing returns that they forget about avoiding losses.
Right, they forget about the downside.
And here's the kicker. The author actually claims there's a product out there that can help investors strike that balance.
Like a magic bullet for investing.
Kind of. Capturing gains while essentially eliminating losses.
Okay, now that sounds way too good to be true.
Yeah, we're going to need a whole lot more information on that one.
Definitely need to dig deeper and see if this product lives up to the hype.
Agreed. Let's put on our skeptical hats and get to the bottom of this.
Sounds like a plan. We'll tackle all that in the next part of our deep dive.
Can't wait.
All right, so we've talked about how buy and hold might not be the sure thing we thought it was.
Yeah, definitely some cracks in that foundation.
And then there's this idea of an investment that can give us consistent returns while avoiding losses.
Almost like it's too good to be true, right?
Right, like some financial magic trick.
It does make you wonder.
Yeah, and we always hear that if it sounds too good to be true.
It probably is.
Exactly. But for a second,
Yeah.
let's just say such a product did exist.
Okay, hypothetically.
What might it look like? How could it even work?
Well, reading between the lines,
Yeah.
it seems like the author is hinting at a strategy
Yeah.
that puts capital preservation front and center
Okay.
and aims for steady, maybe even limited gains.
So not those huge swings we see in the market.
Exactly. Think of it like building a portfolio
Okay.
that can handle the ups and downs.
Like it's waterproof.
Yeah, and still delivers steady growth over time.
Like a ship built to sail through any storm.
Exactly, no matter what the market throws at it.
So instead of trying to pick the perfect stocks,
Yeah, or time the market perfectly.
this product would spread the risk around.
Diversification.
You got it. Like investing in different types of assets, stocks, bonds, real estate.
Even commodities, things like that.
Right.
Yeah.
Making sure your portfolio isn't all in one basket.
Exactly. And not only that, it's not enough to just diversify across those broad categories.
Oh, I see.
You also need to diversify within those asset classes too.
Give me an example.
Sure, like with stocks.
Yeah.
You wouldn't just buy shares of one or two companies.
Right.
You'd want to invest in different industries, different sectors.
Oh, so like making sure your portfolio has a well-rounded diet.
Perfect analogy.
Yeah.
And just like your diet changes over time, your portfolio needs to adapt too.
Makes sense.
Someone younger can take on more risk.
Right, because they have more time to recover if things go south.
Exactly. But as you get closer to retirement,
You might want to shift something a little safer.
yep, like bonds, for more predictable income.
Okay, so this isn't just a set it and forget it kind of thing.
Nope, you got to stay engaged.
Right, keep things balanced as your life changes.
Absolutely. And beyond diversification,
Yeah.
there's another important piece of the puzzle: risk management.
Ah, something I feel like a lot of people forget about.
Yeah, it's all about setting some ground rules for your investments.
Okay, like setting boundaries.
Yeah, putting up safeguards to prevent big losses.
That makes sense, but how do you actually manage risk?
Well, one practical tool is a stop-loss order.
Stop loss, what's that?
So you set a specific price
Okay,
below what you paid for a stock.
right.
And if the stock drops to that price,
Yeah,
it automatically sells.
so you cut your losses before things get worse.
Exactly. It's like setting an alarm.
Uh-huh, I like that.
If your investment dips too low,
Yeah.
it triggers a sale to protect you from further losses.
So even if you don't sell at the perfect time,
Right.
the stop loss is there as a backup.
Exactly, like a safety net.
Makes sense, but what about those gains?
Right. The other side of the equation.
How do we work towards those consistent, limited gains?
Well, one strategy is dollar cost averaging.
Okay, break that down for me.
Instead of trying to perfectly time the market.
Which is pretty much impossible, right?
Yeah, exactly. You invest a fixed amount
All right.
at regular intervals.
So like putting in the same amount every month.
Exactly, no matter what the market's doing.
That
It helps you average out your purchase price over time.
makes sense. So you're not buying high and selling low.
Right. It takes the emotion out of it.
Yeah, no more panic selling or FOMO buying.
And that brings us to another crucial element. Patience.
Patience, the hardest part.
Is true.
Everyone wants to get rich quick.
Right, but building wealth through investing,
Yeah.
it's a marathon, not a sprint.
No quick fixes.
Don't get distracted by the short-term ups and downs.
Okay, so tune out the noise.
Focus on the long game.
Easier said than done, but I get it.
It's about shifting your mindset.
From chasing those quick wins to building something sustainable.
Exactly, wealth that lasts.
So how do we actually put all this into practice? What are the tangible steps?
That's the million-dollar question, and it's what we'll explore in the final part of our deep dive.
Okay, the grand finale.
We'll move beyond the theory
Yeah.
and get into the specifics, strategies, tools, even some resources.
Awesome, because we need more than just concepts.
Right, we need action.
Exactly. Give us the tools to build that resilient portfolio.
One that can weather the storms and help us reach our financial goals.
Can't wait. Let's dive in. Okay, so we've spent some time talking about the potential downsides of buy and hold.
Right, and how that classic strategy might not always be the best fit.
And then there's this whole other idea of an investment approach that's all about protecting your money.
Yeah, making sure you don't lose what you've worked so hard for.
While still aiming for those consistent, steady gains.
Right, finding that balance.
Well, let's get real.
Yeah.
Most of us listening aren't exactly financial experts.
You need something we can actually use.
Exactly. So what can we actually do with all this information?
That's the key question, right? It's one thing to understand the ideas,
Yeah.
but the real magic happens when you put them into action.
So let's break it down.
Okay.
Make it actionable.
Sounds good.
Starting with capital preservation.
Okay.
What are the main strategies we should be thinking about?
Well, we've already touched on diversification.
Right. Not putting all your eggs in one basket.
Exactly. And that's absolutely crucial.
But it's more than just spreading your money across different types of investments.
Right. It's not just about having some stocks, some bonds, maybe a little real estate.
Yeah.
It's also about diversifying within those categories, too.
So, like, within stocks, you wouldn't just buy shares of a couple of companies.
You'd want to spread it out more.
I see.
Invest in different sectors, different industries, maybe even different countries.
Like making sure your portfolio has a balanced diet.
Exactly. A healthy mix of everything.
I love that analogy.
And just like your diet needs to change as you get older,
Yeah.
your portfolio probably needs some adjustments, too.
Makes sense.
A younger investor with more time can handle a little more risk.
Right.
But as you get closer to retirement...
You want to play it a little safer?
Exactly. Maybe shift towards more stable investments like bonds.
Okay. So it's not a set it and forget it approach.
You got to stay active, keep things balanced.
All right. What else can we do to protect our investments?
Well, that's where risk management comes in.
Risk management feels like something people don't always think about.
Yeah, it's about setting rules for your investments.
Okay, so like setting boundaries.
Yeah, think of it as putting up safeguards to prevent big losses.
I like that, but how do you actually do that?
Well, one practical tool is a stop-loss order.
A stop loss. Okay, tell me more.
So you pick a specific price
All right.
below what you paid for a stock.
Okay.
And if the stock drops to that point,
Yeah.
it automatically sells.
Oh, so you limit how much you can lose.
Exactly. It's like an insurance policy.
I see. So even if you're not watching the market constantly,
Right.
the stop loss is there to protect you.
It's like a safety net.
Love it.
Yeah.
But we've been talking a lot about preventing losses.
Yeah.
What about actually making money?
The fun part.
How do we ensure we're working towards those consistent gains?
Well, one popular strategy is dollar cost averaging.
Okay, break that down for me.
It's pretty simple, really.
All right.
Instead of trying to time the market.
Which, let's face it, is impossible.
Pretty much, yeah.
Okay.
You just invest a set amount of money
Right.
at regular intervals.
So like every month.
Exactly, regardless of what the market is doing.
So whether prices are up or down?
Doesn't matter, you stick to the plan.
Okay, that seems like it would take the emotion out of it.
Exactly, no more panic selling when things dip.
Yeah, or getting caught up in the hype when things are booming.
It's all about staying disciplined.
And patient, right.
Patience, the key ingredient.
Everyone wants to get rich quick.
It's tempting.
But building real wealth takes time.
It's a long game.
Like a marathon, not a sprint.
Exactly, so tune out the noise.
Right, all those daily ups and downs.
And focus on the bigger picture.
Focus on where you want to be in the long run.
That's the key.
I love that. So if we had to sum up everything we've talked about today, what's the most important thing our listeners should take away?
I'd say the biggest takeaway is to be proactive. Take control of your financial future.
Don't just blindly follow the crowd.
Exactly. Do your own research.
Explore different strategies.
And find an approach that works for you.
One that aligns with your goals and your risk tolerance.
That's how you set yourself up for success.
It's about empowering yourself.
Absolutely.
Making informed decisions that are right for you.
And remember, investing is an ongoing journey.
It's not a one-time thing.
It's about constantly learning and adapting.
Yeah, always refining your approach.
That's how you stay ahead of the curve.
Well said. Well, on that note, we're going to wrap up this deep dive.
Always love these conversations.
Me too, but before we go,
okay,
we want to leave you with one final thought.
All right, hit us with it.
Imagine you could create the perfect investment.
The holy grail of investing.
The one that perfectly balanced risk and reward.
That's a tough one.
What would it look like?
Yeah, what features would it have?
Let that question simmer in your mind.
Something to ponder.
As you continue exploring the world of investing.
It's a fascinating world out there.
And remember, the more you learn, the better prepared you'll be to navigate the markets.
And reach your financial goals.
So, keep learning.
Stay curious.
And we'll catch you on the next deep dive.